All right, today we are unpacking one of the most famous ideas from the legendary economist John Maynard Keynes. We're tackling a question that seems super simple on the surface, but it's really at the heart of modern economics. Why do you keep cash in your wallet instead of investing every single dollar? The answer, as you'll see, pretty much changed everything. Seriously, think about your bank account for a second. Why is there money just sitting there? Why isn't every last penny you have working for you in stocks or bonds or real estate, earning some kind of return? It kind of seems illogical, right, to just let cash sit idle? But we all do it. And the reason why we do it is the key to understanding Keynes's entire theory.
And Keynes had a name for this. He called it liquidity preference. It's a really simple but powerful idea. Basically, we actively choose to hold on to liquid assets, cash, over illiquid ones. This isn't some accident or oversight. It's a deliberate preference for the safety, the certainty, and the spendability that only cash can give you.
Okay, so why do we have this preference for holding cash? Well, Keynes didn't just give one simple answer. He actually broke it down into three distinct motivations, three separate reasons that drive our demand for money.
So these are the three pillars of his theory. You've got the transactions motive, the precautionary motive, and then the one that was a real game changer, the speculative motive. Let's break them down one by one.
First up, we've got the most obvious one, the transactions motive. You just need cash on hand to live your day-to-day life, right? You might get paid once or twice a month, but you're spending money almost every day. This is the cash for groceries, for rent, for your morning coffee, all the predictable stuff. And it makes sense that the more income you have, the more you're going to spend, so the more cash you need for these transactions.
Next up is the precautionary motive. You can think of this as your rainy day fund or your just-in-case money. Because, let's face it, life is totally unpredictable. You might get a flat tire, have a surprise medical bill, or maybe your paycheck gets delayed. You hold cash to protect yourself from all that uncertainty. And, just like with transactions, the higher your income, the bigger you probably want that safety net to be.
And that brings us to Keynes' most revolutionary idea of the three, the speculative motive. Now, this is where money stops being just a tool for spending and becomes an asset in and of itself. It's a way to make a strategic bet on what the future holds. Keynes argued that this bet on the future was basically a gamble, specifically a gamble on the bond market. It's all about holding cash not just to spend it, but to wait for that perfect moment to jump in and invest for a profit. And this was Keynes' big innovation. Before he came along, most economists saw money as just a tool for buying things, what they call a medium of exchange. But Keynes said, no, it's also a store of value. It's an asset that you can strategically hold on to, waiting to make a speculative gain, especially in the bond market. Now, to really get this, you have to know one crucial rule. Bond prices and interest rates always move in opposite directions. Think about it like this. If you buy a bond today that pays 3% interest, and then next week the central bank issues new bonds that pay 5%, well, your old 3% bond suddenly looks a lot less attractive, doesn't it? Its price has to fall just to compete. So if you expect interest rates to go up in the future, you're not going to buy bonds today. You're going to hold onto your cash, speculating that a much better deal is right around the corner.
This speculative behavior is absolutely key, because when you take it to its logical extreme, it leads to one of the most famous and frankly feared concepts in all of economics.
This chart here pretty much shows how it all works. You've got the interest rate on the vertical axis and the amount of cash people want to hold on the horizontal. See how that curve slopes down? It means when interest rates are high, the reward for buying bonds is huge, so people hold very little cash. But as those interest rates fall, bonds become way less attractive and people start to prefer holding more and more cash instead.
So that leads to a really fascinating question, right? What happens if interest rates fall so low that they're practically zero? I mean, where can they possibly go from there?
And this is the answer, the liquidity trap. When you get to near zero interest rates, pretty much everyone believes that rates have nowhere to go but up. And if rates are going to go up, what does that mean? It means bond prices are going to fall. So nobody wants to buy bonds. Everyone just hoards cash, waiting for that inevitable rate hike. The demand for money becomes almost infinite, and that curve goes completely flat.
So here's the really crucial point. When you're in a liquidity trap, the central bank loses its most powerful tool. They can print and pump tons more money into the economy, but it won't lower interest rates any further because they're already at zero. People will just take that extra cash and hoard it. Monetary policy becomes completely ineffective, and the economy just gets, well, stuck.
To really appreciate just how groundbreaking all of this was, let's quickly put it in some historical context.
How did Keynes's whole idea of liquidity preference stack up against the economic theories that came before him?
I mean, this table just shows you how radical the shift was. The classical view before Keynes was pretty simple. People hold money only for transactions. That's it. The interest rate had no role to play. But Keynes just flipped this whole thing on its head. He said the interest rate is crucial because it's what drives speculation. And that single idea redefined what money is. It's not just for spending, it's also an asset that you hold strategically.
Of course, no theory is perfect, and critics will point out that a true, complete liquidity trap almost never happens in the real world. Keynes also focused pretty much exclusively on bonds, but today we have this huge universe of other assets like stocks and crypto, and some even argue that our day-to-day demand for cash for transactions can also be sensitive to interest rates, which is something Keynes kind of overlooked.
And that really brings us to the big final question. Keynes wrote all this way back in 1936. So in our modern world of digital wallets, cryptocurrencies, and years of near-zero interest rates, how much does his theory of preferring to hold cash still apply? It's a pretty fascinating question to think about.